Hey, what's going on everybody? Welcome back. It's Travis here with JT Wealth. Did you know that from 1980 to 2019, the S&P 500's return was over 8,300%? And more importantly, that there's a specific investing strategy that is responsible for 75% of that growth. And in today's video, I want to show you guys two specific stocks to help you take advantage of that exact strategy so that you can benefit as much as possible in the same way the smart money is doing it. So let's get into it. All right, welcome back to the channel, everybody. Thank you so much for checking out today's video. If you don't mind, take 2 seconds, hit that like button, and consider subscribing to the channel if you haven't already. Now, this may come as a surprise to a lot of you. Some of you have already made the connection, but that S&P 500 growth from 1980 to 2019 is massive. 8,300% is a huge number, but that 75% of 8,300% is all dividends. Absolutely all dividends. So only 25% of that was actual stock appreciation. The other 75% was stock dividend payouts. So I want you to think about that long term. No matter what you're investing in the S&P 500, if it didn't pay out dividends, it did not compete with the stocks that do pay out dividends in that huge, almost 39-year period. So if you're like the smart money, you want your money invested in dividend paying stocks, whether that's an individual stock or an ETF, I'll let you make your own decision. But in today's video, I'm going to showcase two different dividend paying stocks, both paying over 9% dividend yield annually and that have room for upside in the next 12 months. But first, I want to show you guys 5 key takeaways regarding dividend stocks and why you should be investing in them. But right before I do that, if anybody is considering opening a new brokerage account to focus on dividends and maybe dividends alone, check out M1 Finance. It is absolutely my favorite app for dividend investing, and it was the source of our dividend investing series that I do plan on doing an update on recently, but I just haven't gotten around to it. So if anybody wants to see an update on where that account sits, let me know in the comment section down below and I'll make sure we get that updated for you as soon as possible. So 5 of the primary reasons why dividends matter for investors include the fact that they are substantially increasing stock investing profits. They provide an extra metric for fundamental analysis. They reduce the overall portfolio's risk, offer tax advantages, and help to preserve the purchasing power of your capital. And the key takeaways here are that companies that issue dividends can provide inherent fidelity to the financial state of the company, and unhealthy companies are generally not in a position to provide dividends to their shareholders. Qualified dividends paid are taxed at rates lower than the ordinary income tax rate between 0 and 20%. And even during periods of recession, dividend stocks have historically shown growth. 75% of the returns from the S&P 500 between 1980 and 2019 came from dividends. All right, but now let's get right into the 2 stocks we're talking about today. And I pulled these from an article from TipRanks that came out on Monday. And it says 2 strong buy dividend stocks yielding at least 9%. So the markets are getting buffeted by a combination of headwinds and tailwinds that make for a very confusing navigation. But corporate second quarter earnings have given the boost, and 85% of the S&P listed firms that reported so far have beaten their forecasts. In another piece of positive news, the July jobs report came in well ahead of expectations with the best performance in a year. Okay, so our first dividend paying stock today is AGNC. And AGNC Investments was trading at about $16.36 today, but they have a strong buy rating and almost a 7% upside potential in the next 12 months to an average analyst price target of $17.46. Now, AGNC is a real estate investment trust, or a REIT. They're a Maryland-based REIT and involved in the purchase, ownership, leasing, and management of real properties. The company focuses its activity on mortgage-backed securities, especially the relatively safe class of loans with backing from the U.S. government. At the end of the second quarter, their portfolio totaled over $87 billion, including $58.1 billion or 66% in residential mortgage-backed securities. The large majority of these are 30-year fixed instruments. And their second quarter results showed net negatives in both revenue and earnings, the first such negative quarter since the first quarter of 2020 at the peak of the big virus. But AGNC's management remains sanguine about the current environment, seeing the improving job situation as a sign that inflation may be temporary, but also seeing the Federal Reserve as likely to raise rates, at least modestly, in the coming year. Now, as far as their dividend goes, the company pays out monthly rather than quarterly at a rate of 12 cents per common share per month, or 36 cents quarterly and $1.44 annualized. This gives them a dividend yield of 9%. Maxim's 5-star analyst Michael Diana gives an AGNC rate a buy and sets a price target of $18, showing his confidence in a 12% one-year upside. Not only is he bullish on the stock, but others are as well, with 7 recent reviews. With a 6-to-1 breakdown of buy to hold, the stock has a trading price around $16 like we mentioned, but it gives the stock a potential 9% upside this year, which should result in an estimated 12-month total return of about 18%. Now, if you're wondering how we got to 18%, you take the dividend yield that you're going to receive annually, regardless, as long as you hold the shares, and then the growth appreciation as well. So if you've got 9% dividend and 9% growth appreciation, you're going to have an 18% total return on the year. Okay, and now on to our second dividend paying stock of the day, and they are ticker symbol MPLX. MPLX is a strong buy stock with 9 analyst ratings split between 7 buys and 2 holds. They're trading at about $28.32 today, but they have almost 16% possible upside in the next 12 months with an average analyst price target of $32.75. Now, MPLX is actually a midstream spin-off of a company you've probably heard of, and that's Marathon Petroleum. They emerged as a standalone company in 2012, taking over the parent company's pipelines, terminals, refineries, and river shipping assets and services. The midstream ops that moved oil and gas products from the wellheads to the refining, storage, and distribution facilities. So their networks of assets stretch across the U.S. from the Rocky Mountains to the Gulf Coast of the Midwest. And that is a very profitable network of assets, showing a second quarter this year has their highest top-line revenues since the first quarter of 2020. They had $2.27 billion in revenue. The company's net income came in at $706 million, which was up 9% from a year ago quarter. And if you are a dividend investor, check this out. They generated over $1.36 billion in net cash during the quarter, including $1.25 billion in distributable cash flow that they were able to return to the shareholders via $900 million between a combination of dividend payouts and share repurchases. So at the end of last month, they announced their regular quarterly dividend payment of 68 cents per common share. And that dividend has held steady at this level for the last 7 quarters. At $2.75 annualized, it gives them a yield of 10%, well above the average found in the broader markets, which is approximately 2%. But still, a 30% return based on a combination of dividends and asset appreciation in the next 12 months is an absolutely fantastic return no matter what stock you're looking at. All right, so those are our 2 dividend paying stocks to look at today, and that's AGNC and MPLX. Let me know in the comment section down below what you guys think of these 2 companies. I know a lot of you who've watched our dividend videos in the past will have heard of AGNC, but MPLX is a fairly new company. I believe this is the first time we've discussed them on the channel. So let me know what you think of these 2 companies. And as always, remember, this is not financial advice. I'm not a financial advisor. It's just provided for information and entertainment purposes only. Thanks so much for checking out the channel, guys. I appreciate it. And until next time, bottoms up.